Hello, class. This is Dr. Sharma again. I'm going over the third part of the financial statement analysis. In this, I'm going to cover the third learning objective that is describe and illustrate how to use financial statement analysis to assess the liquidity. Now, in case of a liquidity, we are going to talk about the current position analysis, the accounts receivable analysis, and inventory analysis. Now, in case of a current position analysis, basically we are trying to find out what is the working capital situation and is the company able to pay off its current liabilities with its own current assets, and does it have enough quick assets to liquidate so that they can pay off the liabilities when they become due. So that is what we are trying to learn in the current position analysis. Now, in case of accounts receivable, now you know accounts receivables are created when we sell goods on credit. Now, when we sell them, we need to sell them as well as collect those accounts receivable in a reasonably good time so that we can maintain our liquidity position. Otherwise, what will happen is you will sell the inventory on credit, you will report that as a revenue, but if you are not able to collect that, you will be showing a huge amount of profit because you're showing them as revenue, but you may not have cash. So that's going to be a liquidity position impact because of accounts receivable turnover. Now, another turnover we are going to talk about is the inventory analysis. Now, in case of inventory, again, you know, when you go to different stores, they have inventory stacked up in their aisles. Now, if you buy the inventory and if you're not able to sell them, what is the use of having those inventory? So that's why it's important that how fast are you able to roll over your inventory, and then how fast are you able to collect the money on the inventory investment. Otherwise, what will happen is you will be paying interest on the amount of money you have blocked on the inventory, and you will be having liquidity problems. So that is why these are the three areas that we are going to cover in this learning objective. Now, as you can see, that analyzing liquidity is essentially trying to evaluate whether a company has enough current assets to convert into cash or not. These ratios basically emphasize what is the position of the company in terms of its current assets and liabilities, as well as accounts receivable and turnover. So, I already explained to you the reason that we do that, because we want to find out how healthy the company is and how much of current asset does it have, and how fast can it liquidate if there is a need to pay off the current liability. So that is your liquidity. Now, the first measure of liquidity we are going to talk about is the working capital. Now, working capital, of course, uh, if you're running a business, you should have enough funds to be able to manage your enterprise on a day-to-day basis. So essentially, what is working capital? Working capital is the difference between the current assets and the current liabilities. When you have more current assets than the current liabilities, it will show a positive working capital. Now, working capital, we would like it to be in a positive domain. So if the working capital positive and higher, the better. So that is the working capital situation. So we'll just list the current assets, list the current liabilities, take the difference, that will give you the working capital. Now, to illustrate the working capital, I have again taken the data for ExxonMobil for 2019 and 2018. That's the latest balance sheet that was available. And as you can see, the total current assets reported by ExxonMobil were 50,052. Of course, all these are in millions of dollars. and last year they had reported 47,973, and they have current liabilities well over the current assets. That is why the working capital, as you can see, is in the negative domain. So as I was saying, that is not a very good what you call position to be in, because if you are in a negative domain, that essentially means you have more liabilities to pay off than you have the current assets. So that is something that you may want to revisit. The company wants to take stock of that and try to improve the situation. Okay, so next, of course, the working capital is used basically to evaluate whether a company will be able to pay off its current liabilities. However, it is quite difficult to use the working capital to compare the companies of different sizes, because supposing if one company is really large and its working capital is 100,000, now there is another small company, it has again 100,000. Now, of course, we will definitely go for the smaller company with the higher amount of working capital. But if there are two comparably large size companies and they have different numbers, you cannot say that the company with the higher amount of working capital is going to be more liquid, because it is just a relative figure. So that's why we prefer actually the current ratio rather than working capital. So that's why we are taking the working current ratio. The current ratio is, of course, it's the same thing. Working capital is the difference between the current assets and current liabilities. In this, we are going to convert that into a ratio, and sometimes it is called as a working capital. Now remember, a rule of the thumb is that if you have a ratio, current ratio of 2, you are considered as fairly okay. Now, does it mean that if you're less than 2, that's going to be a suspect? But some companies don't mind bringing it down to 1 even. So definitely, we would like to be in a domain where my current ratio is 2. So that is your current ratio. Now, how do you calculate? Again, taking Exxon Mobil's example, I'm going to uh, demonstrate that calculation. So now in the calculation, as you can see, we already have seen these figures. So we are taking a ratio of these two figures, and getting a ratio of 0.78. Now, considering the rule of the thumb, the company is not doing very well in that respect. It is below 1. And of course, conservative estimate is 2. Now, it is, some people tolerate up to 1, but it is below 1, so they need to do something about this. Now, of course, as you can see, the current ratio higher the better, so it means in 2018 it was better than 2019. So as the year progressed to 2019, the company is not doing as well as it was doing last year. Now, as I said to you, it is considered more reliable indicator of a company's ability to pay its current liabilities than its working capital. Because if it is a working capital, a positive amount, even if it is $1, then we are okay with that. But a current ratio is much easier to compare across companies, because it is in a ratio form. So that is your current ratio. Now, the next ratio we are going to talk in this segment of the lesson is quick ratio. Now, quick ratio is also called acid test ratio. As the phrase suggests, acid test is, of course, one of the pretty difficult tests to pass. So, uh, and we also call it as a quick ratio, because what we are trying to do is we are trying to find out how quickly a company can pay off its debt. So basically measuring the ability to pay off its debt in a very short period of time. So the quick ratio, of course, is computed by taking the quick assets divided by the current liabilities. Now, the current liabilities are the same as we used in the current ratio. So the quick assets, of course, not all current assets are quick assets. So that's why we have to identify only the quick assets. Quick assets are basically cash and other current assets that can be easily converted into cash. They can be liquidated in a short period of time. So examples would be cash, temporary investment, receivables, but we will exclude the inventory and prepaid assets. Now, inventory, it is there because we couldn't sell them off, so we couldn't consider that as a liquid. And prepaid assets are expenses that you have paid in advance and it is not possible to get back in a short period of time. So that is why we exclude those two from the quick assets. So what I have done is I have shown ExxonMobil's current assets and I have crossed out those assets which we do not consider them as liquid. So we consider the cash and cash equivalent as liquid. Notes and accounts receivable less the allowances for bad and doubtful debts. So if you add these two, we get a quick assets of 30,055. Again, these are in millions of dollars. And the current liabilities, we are given notes and loans payable, accounts payable, and accrued liabilities. These are short term, so that's why they are classified as current liabilities, income tax payable. And if you add these up, you will be getting 63,989. So if you add these three up, you will be getting that. And then we get a quick ratio of 0.47 and 0.49. Again, like in the current ratio, the company was doing fairly well, in better. No, I couldn't say fairly well because we expect the quick ratio to be at least 1. It isn't. So that's why, as compared to the last year, this year the company is doing worse off. It has more current liabilities than the current quick assets. So that's why we couldn't say that it will be able to pay off its current liabilities in a short period of time. Okay, now we move on to the next ratio, that is the accounts receivable analysis. Now, in these, we are going to talk about two ratios. One is the accounts receivable turnover, the other is number of days sales in receivables. So, in this accounts receivable turnover ratio, basically what we try to do is we try to find out how well are you able to collect the accounts receivable once you sell those goods on credit. So, as I already said in the opening statement, sales is recognized as a revenue as soon as we have earned it. But if they are not collected in cash, then your what you call cash will get tied up on the receivables and will impact the liquidity. It also will impact the day to day operation of a company as it will spend the resources to buy but may not collect, because to sell them you have to buy the goods or services. And then when you are able to sell them but you are not able to collect, then it is possible that it will impact the day to day operation. And as they grow old, the collection accounts might there is a chance of not getting collected. So therefore, the possibility of debts going bad or uncollectible account is grows is continuing to grow because of that situation. So, how do you calculate the accounts receivable turnover ratio? Accounts receivable turnover ratio is computed using the formula sales divided by average. Now, average essentially means now sometimes you may not be able to calculate the average. So, if you are not able to do that, then use the current year's accounts receivable amount. So, if you take the example of ExxonMobil again, in 2019 2018, sales and other operating revenues were 255,583 and 279,332. Notes and accounts receivable less the estimated doubtful debts were given as these figures 26,966. So we add these two figures and divide by 2. So if you do that, then you get this figure. So that's why I've shown here 26,966 plus 24,701 divided by 2 will be the average one. So accounts receivable turnover ratio is this one, that is sales divided by the average accounts receivable. So that comes out to be 9.89. Now, as I said to you, supposing if these figures were not available, you would take that figure to calculate, because you can calculate the average, because if you're not given 2 years, don't make a mistake of dividing that figure by 2 when you don't have the second figure. Just take that as such. So you'll be dividing, instead of 25,833, you would divide by 26,966. But if you are given the 2 years figures, you don't have an option. You have to take out the average. So you may ask, is this good, 9.89, or bad? Now, definitely, it's a relatively relative figure, so we can say either way, but we can make a comparison. If you're comparing the same ratio with another company, the other company has only 5, so that means 9.89 is definitely better than the 5. So we'll have to compare those ratios in terms of different companies in the same industry, or you can just compare the two companies, or between years, just to calculate progression of those receivable turnover ratios. Now, once you have taken out the receivable ratio, we can go on to calculate the number of days sales in receivable. Essentially, how many days does it take for the receivables to be collected? So that is what it is. Now you have two options. One option is, if you have already calculated the receivable turnover ratio, then you can use this formula, because you just take the 9.89 here and calculate that ratio. But if you are not calculating a receivable turnover ratio, you are directly calculating the number of days sales in receivable. You can use the alternative ratio. So that is, first number of days sales in receivable is average accounts receivable. So that we have already calculated that amount, and divided by average daily sales. Of course, average daily sales would be this amount here divided by this amount here divided by 365. So if you are doing for 2019, of course, you would take 255, 583. If you're doing for 2018, you would take the figure for that year. So that's another way of doing the calculation. So let's take both of the calculations. First days in the year is 365, and we had calculated 9.89 as the accounts receivable turnover ratio for 2019, and then we get number of days as 36.9. So that means every we are taking almost what you call a month to collect our receivable. So that is your number of days. So we are turning over the receivables 9 times a year. So therefore, the average number of days sales in receivable is 36.9. So that is, now you come to the same a number using the alternative formula. That is, we start with the average accounts receivable. We had already calculated that. Then we take the sales divided by 365, we get average, and then we divide the two. So you will be getting, that is, you divide this average with number D. So that would be 36.9. So these are um, the four ratios that we have taken. Now, next analysis we'll be doing is the inventory analysis. Now, again, as I had said to you, we want to analyze the inventory in terms of its turnover. How fast are you able to sell off the inventory and convert that into cash? Or number of days sales, in how many days does the inventory stay in your place. So that will be your inventory analysis. Now, the inventory turnover is computed by using the formula cost of goods sold divided by average inventory. Again, like average receivables, we add the 2 years 2019 2018 and divide by 2. If you have given only 1 year's figure, then you can just take one figure. That's how we need to understand. Now, in this case, since this is a real life example for ExxonMobil, they did not give you the cost of goods sold directly. So that's why we calculated that cost of goods sold by taking the crude oil and product purchases, production and manufacturing, and then depreciation and depletion. Now, some people would exclude the depreciation for office equipment, but we are not sure whether it was office equipment or for the production. So that's why we are considering that as a production depletion, basically, because this is an energy company, that's part of the cost of goods sold. But depreciation, it could go either way, but we are making that assumption. So if you add this figure here and this one, you calculate that as 199,625. Now, basically, we don't want to include general office and selling and distribution expenses as part of cost of goods sold. That's not a cost of goods sold. So we calculated cost of goods sold to be 199,625 million dollars divided by the average inventory. So average inventory, of course, the inventories we were given was crude oil, product, merchandise, and materials and supplies. So we calculate the total inventory to be these amounts, and then we add these two and divide by 2 will give you 18,743. And if you divide this with the average one, you will be getting this 10.65. So that's the turnover ratio. We are rolling our inventory 10 times a year. So is that good or bad? Again, I said to you, it's a relative one. Depends upon the size of the company or depends upon the kind of company, because some companies have to roll, like if you take an example of a milk, you have to sell off that milk before it gets bad. So your inventory turnover ratio is going to be very high. Now, in case supposing if you're talking of a home, then you might take some time to sell a home, so that turnover ratio is going to be lower in that case. So that's how we look at the inventory turnover ratio. Again, similarly, the number of days sales in inventory is computed using the two alternative formulas. Now, as I said to you, if you are already calculating the inventory turnover ratio, we have done that 10.65. I can use that and calculate how many days does it take to roll the inventory. But if you are not doing that, if you want to start from scratch, then you can do the average inventory. We already know average daily cost of goods sold, of course, will be cost of goods sold divided by the number of days in the year. So that will be 365. Now, we calculate the same number of days using alternative formula. The first formula results in 34.27. So that means we are taking little more than a month to roll our inventory. So that is 34.27. Using the alternative formula, again, what we are doing is average inventory. This was inventory for 19, inventory for 18 divided by 2 will give you average. Then cost of goods sold, we already calculated. If you look at that figure here, that was the cost of goods sold. So we're taking that, and cost of goods sold was of course, then you divide by 365 to get an average daily cost of goods sold. And then you do A, that is average inventory divided by this figure, will give you 34.27. The same answer we got in the previous formula as well. These are alternative formulas and will result. So we're taking little more than a month to roll our inventory. Now, as I said to you, the rolling of the inventory is just a rough estimate as to how many days does it take to purchase, sell, and replace the inventory. Faster you roll over the inventory, better it is, because you are not sitting over the inventory in your shelf or in your godown. So now with that, I come to an end of this presentation, this part. So we will be I'll be revisiting